A warm welcome to our monthly market update. My name is Colin Beveridge, Chief Investment Officer at True Potential. Now, over the previous month, investors have witnessed equity markets in the US hitting new all-time highs. Share prices are being helped along by strong job creation, moderate inflation, a weaker dollar boosting US exports, and rising US corporate profits. Good news on this scale has not been confined to the US. Europe is beginning to show improvements in its economic performance. Confidence is improving, with economic sentiment rising to a decade high on the back of increased optimism around services and construction. Now, although economies and riskier assets are performing well, the media continues to focus on potential for bad news. One area facing challenges is fixed income investing. Investors owning bonds are grappling with inflation expectations moving up and down and trying to judge the mood of central bankers who set interest rates. Now, since December 2016, we have seen 3 quarter-point interest rate increases in the US. This has been a restraining factor for bond prices, with yields pushing up in some areas, but interestingly, it has not restrained equity markets. Despite all the media warnings that interest rate increases would require equities to fall, share prices globally have in fact continued to rise. Looking ahead, investors anticipate that central banks in the US, Japan, Europe, and in the UK will act with caution. If interest rates need to rise, it will be gradual, keeping monetary conditions supportive for investors. As advocates of diversification, a key advantage we believe it offers investors is the option to tune out of market noise around growth, inflation, interest rates, and currency, accepting that some areas will be doing better, others worse. As I have said, this is true right now for bonds versus equities. Presently, our investment partners are more inclined to hold bonds for defensive reasons, rather than for their yield attractions, which are diminished relative to history. However, bonds within a multi-asset portfolio can protect against the possibility of dislocation in the global economy and act as a shield against unexpected negative events. Tactically speaking, our manager partners have been lowering bond duration, which in simple terms means they are lowering portfolio sensitivity to interest rate hikes. If bond yields continue to rise, short duration portfolios maturing earlier will be in a better position to reinvest on more favourable yield terms. Meantime, from our table of market returns, you can see equities over the month producing strong returns, led by emerging market equities. One area where we have seen high volatility and poor returns is in commodities, and in particular, the oil price. Although the oil price has bounced by around 6% over the month, helped by Saudi Arabia saying they're committed to dealing with the global oil supply glut, the price is still down 16% this year. The ability, or perhaps more correctly, the inability to control supply is causing many headaches for the oil industry. However, in these circumstances, stock picker managers can selectively navigate areas around areas like the oil sector, where powerful downtrends are evident. Our investment philosophy is to benefit from both active stock picking and from passive tracking of an index, which lowers costs. Finally, a word on currency. Sterling's depreciation since Brexit has boosted the value of overseas investments. Last month, sterling appreciated against the dollar, but weakened against the euro, demonstrating that sterling can get caught up in crossfire played out across global currency markets. Currently, the market mood is positive on European economic recovery and a little bit more negative on the lack of a Trump boost to economic growth in the US. But of course, this can change. Our portfolio currency positioning varies, reflecting the different approaches of our managers. For example, 2 are fully hedged against sterling strengthening, 1 is half hedged, and the remainder are strategically hedged depending on strength of their view. We believe this is a further example of our highly diversified approach. Advanced diversification is aligned with downside management, but it also takes aim at a wide opportunity set to capture upside potential. Thank you for listening.
Hello ladies and gentlemen, hope you're all well. Welcome to today's review of the True Potential portfolios. So my name is Chris Leyland, I'm the Deputy Chief Investment Officer here at True Potential, and today I'm going to spend the next few minutes talking about our flagship investment product, that is the True Potential portfolio range. Okay, so let's start off by discussing the performance of the portfolios. Then what I want to do is look at the key themes that we're seeing from our fund manager partners, and finally discuss what changes have been made over the month. Okay, so let's look back over the month of July. The portfolios have shown some solid positive returns, with equity markets, particularly in Far Eastern and emerging economies, driving performance. Looking further back, the True Potential portfolios all show double-digit returns since inception, with investors clearly being rewarded for taking risk. Okay, so let's look a little bit more in depth at how the funds have performed that make up the portfolios. And we've seen some strong returns from the True Potential 7IM and the True Potential UBS fund ranges. 7IM's Asian and emerging market exposure, but also their alternative positioning, particularly in the market neutral space, have really helped to drive performance over the month. The True Potential UBS fund range continues to go from strength to strength, with another solid set of performance figures helping to build on the strong numbers that we saw earlier in the year. Okay, so moving on, as you know, we speak to our fund manager partners at least monthly. And what we're looking for, we're looking to find key themes and then tilt the portfolios towards these key themes in order to take advantage of them. So overall, in general, our managers are cautiously optimistic around market conditions. They take the view that while we may shortly come to the end of a loose monetary policy environment, they do not see a catalyst for equity markets to derail. They're cognizant that valuations are pricing securities at high levels by historic standards, but take the view that a downward correction would be a buying opportunity, with the cash available and sitting on the sidelines. Moving on to UK interest rates, none of our manager partners right now see interest rates rising this year within the UK. Okay, so let's move on to trading that's taken place within the portfolios over the month. We've carried out a number of changes this month. They lie within our cautious, balanced growth, cautious plus, growth plus, cautious income and balanced income portfolios. Over the month, allocations have been increased to the manager styles of Allianz, Goldman Sachs, Close Brothers and UBS, whilst SCI, Schroeder and Columbia Threadneedle have been reduced. Okay, so let's start off with Allianz. Their allocation has been increased because of their ability to be very nimble, reacting quickly to changes within markets. Also, they've taken risk levels down with the introduction of an absolute return strategy within our funds, and their current low risk positioning also acts as a hedge within the portfolios should there be any short-term volatility. Okay, so let's move on to Goldman Sachs. So the allocation towards the True Potential Goldman Sachs Income Builder Fund has been increased. And that's because of Goldman's ability to source income from both traditional and non-traditional areas. Their fully currency hedge positioning also helps guard against the risk of sterling starting to rise. We're also attracted by their ability to select securities on fundamental considerations, and this has been working well. Moving on to Close Brothers, their allocation's been increased, and this is due to their excellent stock picking ability that's really shined through this year, and also their managed exposure to sterling helps to mitigate negative currency moves. As we progress through the market cycle and with most asset prices having risen, stock selection becomes a more important way of separating winners from future losers. Their fundamental and technical screening criteria, alongside a stop-loss discipline, will assist them to navigate changing market conditions. Next, let's talk about UBS. Their core portfolio approach has driven consistent returns across the risk spectrum, and this is why we've increased their allocation within the portfolios. This is fulfilled by injecting the same core portfolio construction into each fund, but with a futures overlay being used to buy more risk assets and government bonds being deployed to dial down on risk. The benefit as well of having an active currency strategy fund, what they call CARS, within the mix has also produced good returns. The currency strategy is also a good way to add diversification. Okay, so let's move on to SEI. So action has been taken to reduce a significantly overweight position, but one that has actually worked very well for us. SEI's bond component is higher duration compared to our other managers, albeit lower than bond index benchmarks. And what that means is their fixed income assets are more sensitive to changes in interest rates compared to our other managers. SEI are also transitioning their manager style emphasis away from value because it's hindered their short-term performance. They are shifting towards momentum and event-driven, which will take a little while to implement. Meantime, however, they continue to offer an extremely attractive and well-diversified manager of managers proposition at an attractive cost. Moving on to Schroders, the True Potential Schroder Balance Fund has been reduced within the models, and that's helped to reduce down the overall cost of the portfolios. Their fund of funds approach is higher cost, but they're aiming to deliver higher returns through the cycle by emphasising capital preservation at points when asset prices are elevated. We're currently finding that a number of our managers have been dialing back on risk, which allows us to be a little less reliant on our funds managed by Schroders. This has the added benefit of us shedding some cost across the models. Threadneedle, the position has been reduced, moving exposure from UK asset selection to security selection that is geographically more diverse, and that's at a time when UK economic data is slightly softening. Looking at the rest of the True Potential portfolio range, allocations have been kept the same, with the optimization of factors continuing to be paramount within the portfolios. Thank you very much for listening, and I will speak to you next time. Thank you.